Welcome to the Burgess Rawson from CBRE Social Infrastructure podcast. I am very excited to be joined by industry experts Mike Vanstone, Natalie Couper, and Adam Thomas. Thank you.
Thanks, Ingrid.
Thanks, Ingrid.
Thank you.
Childcare and social infrastructure is one of the booming industries of commercial property in the last decade. And the three of you have been at the absolute forefront, selling 3 out of 5 childcares that come to market and transacting over $2.7 billion worth of these assets. So it's so good to have the experts in the room. And what I want to do for our listeners is explain to them what is childcare, what is the appetite by investors, and what should we be looking for when we buy these assets. Adam, you've been transacting these assets longer than anybody. What is driving the market? Why have these been such a darling of the investment market for so long?
Oh, thanks, Ingrid. What we've seen over the last 10 to 12 years is really a flight to quality. So operators, they're out there, they're improving their educational, their co-curricular, and all the other activities that and educational platforms that they provide. And we've seen that, of course, early intervention in education and care leads to those better outcomes, those social outcomes, those educational outcomes, and associated benefits such as that.
And has that then driven things like the size of the property, the location of the property? How has that translated to a commercial investment landscape?
Absolutely. We found a bit of a sweet spot. Initially, there was a cap on the number of places in Queensland where privatised childcare first started.
What was the cap?
75. So
You're
it was capped
kidding me.
at
I didn't know that.
75, yeah. So we saw, and there's some instances where we've seen
Side-by-side buildings,
side-by-side,
75.
yeah.
So they have a total number of 150 places.
Yeah, so a party war, but basically 2 centres built sort of back to back. But since that cap's been lifted.
And when was that lifted?
In the 90s, that was lifted. And as a result, we've seen operators increase their size. There's an optimum size. We did tend to see a lot bigger centres probably 4 or 5 years ago, 135, 145 centres. But from an operator standpoint and the feedback that we receive, between 110 and 120 places is a really good and the most efficient size for a long daycare centre today.
And obviously we transact all across Australia, but you're specialists in your locations. Mike, certainly for you, transacting in New South Wales in the last decade, your land values have been flying more than anywhere else in Australia. Yeah. How has that affected the ability to bring these developments to market, and how has that affected price?
I'd say probably what's happened is the margins of those developments have sort of been sliced. From when I first started selling childcare, a margin for a development would be 20-25%. Since the values of land has actually skyrocketed and development costs have also almost doubled, probably since I've started, there has to be some sort of give somewhere so that the actual margins of the developers dropped. So we've seen, developers really, as Adam said, just building on quality with their centres to differentiate their centres from somewhere else.
And has that also translated into a higher per place rent?
Definitely. So in the last 3 years, I think I've seen rents go up by 30% just to cover that margin, right? So the developer has to make money to make it worthwhile, right? So someone's had to give. So rents have gone up. Fees have also gone up as well. So we've seen rents go from probably $3,500 a child to now as high as $7,000 a child.
And that's New South Wales specific.
Yeah.
Adam, moreover, across all of Australia, what have you seen in relation to general fee range and fee increases?
Yeah, definitely the fee increase with the additional sort of childcare subsidy and especially if we cast our mind back to COVID, those glorious days of COVID in 2019-20, where we had the childcare relief package. So that provided operators funding to remain open for key and essential workers at the same time. And more recently, probably the last 2 years, there was an additional subsidy paid to operators just to pay for staff and the increased cost of living at the same time. I probably wanted to touch on to Mike's point about the rents, and if we talk about rents holistically, operators are now more selective because construction costs have increased. rents are higher, so operators are paying a higher per place rent, but probably a similar rent as a percentage of their gross occupancy cost. But as a result, they're more selective because developers are having to fork out a higher amount of capital, given both the land and construction increase, significant increases. So as a result, tenants are far more selective in their site identification, and that will give investors, I believe, comfort that there's not going to be one opening next door because the barriers to entry are so much higher than what they were previously.
And that's a huge shift because that didn't exist 5 or 6 years ago. Natalie, talk to me about Victoria specifically. Obviously, land tax is a hot topic in Victoria at the moment. Do childcare tenants pay land tax?
Well, it will depend on the lease that's obviously in place. If it's a retail lease, then that's a non-recoverable outgoing. There are a significant number of leases here in Victoria paid land tax paid by the operator or the tenant. So it really does depend on the lease that's in place. And obviously here in Victoria, not just in childcare, but across any other sector, land tax has been a considerable consideration for many ingoing new investors. But it also depends on whether or not it's their only investment they have in Victoria, because there would then need to be considerations on that land tax component. Because if you're buying a childcare centre in a regional location, the land tax component can be quite minimal, so it doesn't really affect the net income overall. But if you've got multiple holdings here in Victoria, then that number can jump quite considerably. And, metro versus regional, then those considerations are even higher again. So there has been, I think, a greater shift towards more regional locations. Luckily, but the childcare sector isn't really, doesn't have the effect of the CIPT tax either. So,
how does land tax work in New South Wales, Mike?
That's the beauty of investing in childcare in New South Wales. A lot of investors across Australia love investing in childcare in New South Wales because it's land tax free. As long as you've meet the minimum requirements to have service approval, you can get a land tax exemption.
Wow.
Which, if you're looking on a single holding basis, it really helps with your land tax bills, especially if you're investing in other states. So it's actually an exemption, so it doesn't actually go against your threshold of land tax if you own other properties around Australia or even in New South Wales.
And going around the grounds in Australia, we obviously sell all across Australia, but I do feel that less childcare comes to market in WA, Adam.
Mm-hmm.
Is that correct? And why is that?
Yeah, it's interesting. I guess we talk about the trends of where I guess more modern childcare has been developed over the years. It probably started on the eastern seaboard through the New South Wales and Sydney and Melbourne growth corridors, and then went into Queensland. And probably the last 4 to 5 years, there's been more childcare centres developed in both the South Australian and Western Australian markets. There's probably less supply there because there's less population growth and less demand at the same time. So I'd say that's probably the main driver in that regard.
And are you then seeing a yield differential? So if I'm buying a childcare in WA versus a childcare, obviously in expensive Sydney, sorry, Mike, versus South Australia or Victoria, is there a yield differential?
There is, and we've seen that probably. It's exacerbated over probably the last 2 or 3 years as a result of relatively better buying conditions on the eastern seaboard. So eastern seaboard investors, generally speaking, are still buying childcare centres in their local markets at a sort of 5 to 5.5, maybe high 5% yield. As opposed to sort of the South Australian, the Western Australian markets, where you're sort of close to 6.25, and that wasn't the case 2 or 3 years ago. But obviously, with the increase in the cost of capital, that's sort of driven better buying or ensured that there's better buying over here on the east compared to other markets relative to what it was back in the day.
Mm. And Natalie, I'd love for the listeners to understand better and just guide me on this. A childcare can be built on industrial land, residential land, or commercial land. So can I build a childcare anywhere?
As long as it meets the local council regulations, obviously. There are lots of childcare centres built on industrial zoned land. We've actually got one at the moment for sale in Sebastopol in a fantastic...
Now, where's Sebastopol?
It's a suburb of Ballarat. But this particular childcare centre is on a high-profile road. built on industrial land, probably wouldn't even know it's built on industrial land. There are other industrial sort of activities around it, but it's on a main transport corridor. So from a parent perspective, you are probably going to be driving past this childcare centre to go to your place of employment in or outside of the Ballarat sort of CBD location. So it doesn't really matter where or what the zoning is as such from an operational point of view, but as long as it's in a key corridor or an ease of access for a parent to actually drive past. And I think that's one of the main, I suppose, key criteria that an operator will look at when they're doing site selection is what is the ease of access for a parent. So I suppose when they're looking for, the next or identifying their next location, that is one of their key considerations. And what side of the road is it on? Is it inbound or outbound? Because that will also determine whether a parent will use your centre or drive a little bit further down to the road that creates the ease of access. We're all time poor in the morning, so if we can get an inbound location for morning traffic, that's, a highly desirable location.
So what I'm hearing from an investor point of view when I'm looking at a childcare, I'm looking very carefully at the location and the accessibility to the location. I'm obviously I'm not necessarily worrying about the zoning of the land per se, but what about the tenant? What investigation should I be doing into the tenant when I'm looking at these type of properties?
I suppose sometimes it depends on the particular investor as well. Some investors really like these larger listed entities, and then we have another investor.
And who are they?
The likes of G8, obviously, the largest listed childcare provider here in Australia. And then we have larger other operators, non-profit, Good Start. And then there's larger other sort of smaller independent that have, in excess of 100
And
places.
who would they be? So if I'm looking at, I know nothing about childcare and I'm looking at these tenants, what are those kind of those big top operators, apart from G8, Good Start? Who else are there?
We've got Guardian, we've got Eden, they've got about 50 centres. We've done Imagine. Help me out here, Tomo.
Oh, sorry.
Care Academy.
Yeah,
I've got blank.
So small cap listed with Nido and Mayfield. We shouldn't put Nido and small cap, but Mayfield are. Nido have probably got upwards of 90 centres today, and they're listed. And then Mayfield are the smaller cap at the same time. You Imagine, your Greenleaves, Edge, Young Academics. There's
Montessori
Little
Academy.
Zags, Montessori
Yeah.
Academy.
And that's
The
something
list
I
goes
find
on.
absolutely amazing about childcare. For example, in fast food, you've kind of got 4 key tenants with maybe 5 secondary tenants. Whereas in childcare, you've got probably 20 really high quality operations across Australia.
And that's a really good point,
Yeah.
because that trend, that's a trend that we've really seen over the last sort of 2 or 3 years. These larger private operators, the 20 to 50 centre operators, your Journeys and the like, we didn't really see many of those back in the day. It was quite I guess an unbalanced, you had the corporates, the listed, and then your mum and dad operators at the other end. And there wasn't really many of the medium to larger privates.
So when did that start?
I'd say probably 3 years ago, maybe a little bit longer, 4 to 5 years ago, it really started, and COVID. There's a different, and we touched on it right at the start of the podcast in relation to service offerings. So they can offer different outcomes and service offerings at the same time, because they've got that
Better economies of scale.
Yeah, and the nimbleness as well. So they're not sort of governed and dictated by sort of shareholders and cumbersome decisions. They can make quick decisions and act relatively quickly and offer a really good service to the local community. And we do see these operators in clusters. They'll have a very successful centre, and then they'll open one, and that's at a high occupancy with a wait list, and then they'll look to open one within the immediate area. And that gives the added benefit of staff across multiple centres, a centre director or an area manager that has a smaller geographical remit in terms of their sort of, in terms of their role. And it's just enabled, I guess, that profile, that identification of that strong brand in that local community. At the same time.
But also, following on from that, Adam, that's the beauty of investing in childcare. Because of the variance of that tenant, it was originally a cottage industry 5-10 years ago, but as the flight to quality, right, we still got the tenants that Adam was talking, the cottage, like the mum and dad operators at one end, and then you've got your GH at the other end. That's the beauty of investing in childcare is you have so many different variations and price points. So if you're new to investing in childcare or in commercial, you can buy a $3 million childcare in Sydney, or you can buy a $12 million childcare in Sydney. And that's the, there's so many different variations. If you're new to investing in childcare, is entry level or these premium at the other end.
And investors see different appetite.
Yeah.
Or there's different appetite in
Yeah.
those as well. Like some people feel really comfortable having a larger tenant, where some investors like the smaller, more personal operated centres as well. They feel like they're sort of more in tune with the business. They're part of the day-to-day operations, where I suppose it just then can fit any buyer profile, what you feel comfortable in buying.
And I think that's completely unique to childcare. It doesn't
it
happen
is.
anywhere else, does it, Adam?
That's right. And as a parent sitting around this table, would sort of know as dropping our little ones off to childcare centres back in the day, you've wanted that sort of continuity of staff at the same time. That's what these privates can offer, because there's so many additional employee benefits that they offer as well. So having the staff and the right staff and warm and welcoming staff is really fundamental to this sector and the majority sectors, but more so childcare at the same time.
So again, if I'm doing my research, how do I find this out? If I'm looking at a property, talk to me about some of the ones that you've got coming this auction, Adam. How do I, as an investor, find out things like occupancy and how they're received within the community? What do I need to do as an investor to get comfortable with some of the assets that we're bringing to market? It's
a good question. Rents. We can delve into occupancy. Operators, generally speaking, it's their IP, so they're not going to be able to divulge that information because that can be used against them if a competitor's looking to come into town. So they're pretty, that's sort of under lock and key, so they're not really amenable to sharing that information. Daily fees, we can look at the rent, we can look at daily fees, and then we can work out the rent as a percentage of the gross occupancy cost and see if we've got a sustainable long-term business.
And what is sustainable? So if I'm looking at that as an investor, what do you call sustainable?
So rents, we've seen rents in pretty much every state but New South Wales. We've got a higher rent as a percentage of the gross occupancy cost. But that's generally because you've got smaller centres and higher land value at the same time.
And he pays no land tax.
So, and you pay no land tax. That's right. So, but the caveat is, or the asterisk is, except New South Wales here, but we have seen rents as a percentage of the gross occupancy cost go from 9 to 10% up to sort of 12-13% today.
And that's still sustainable?
That is sustainable,
okay.
Absolutely. And then in Victoria, in New South Wales, I should say, rents are sort of 15%.
15%. If you move further out Western Sydney, you might get away with 13.5 to 14%, but generally it's going to cost the same amount of money to build a childcare in Western Sydney as it is in another location in Sydney, roughly, right? Mm-hmm. Depending of access to that suburb, but generally across the board, your childcare is going to cost the same amount in Western Sydney. Mm-hmm. But the rents as a proportion of your fee, right? So Western Sydney, the fees are relatively similar to, say, Turramurra. So
now, where's Turramurra?
Turramurra is like the northern beaches of Sydney, right? So what I'm seeing is a lot of developers have moved away from the eastern seaboard of Sydney and moving out towards west because the fees relative to the rent are way more attractive for a developer.
So, Adam, we talked about the last 10 years. What about the next 10? And obviously, you haven't got a crystal ball, but what do you think is going to drive childcare into the future?
Absolutely. We believe population growth without a shadow of a doubt. We've got the Productivity Commission with their reports in terms of childcare and the ability to for someone to educate the young one for mum and dad to sort of go to work. And we know that we all want the new house and the new cars, and mum and dad generally have to go to work, or both parents, I should say, have to go to work as well. And we've sort of seen that. So what we need to do, and we saw the RBA results out yesterday in terms of their sort of employment figures. So in order to keep employment down or for the productivity to continue, then we need more and efficient childcare centres at the same time.
And one of my favourite things about childcare, Nat, is that effectively it's government funded. So how does the government funding work in relation to childcare?
So it's all means tested. on a household income, the economic pressures of both parents now need to contribute to the household income is certainly a driving force on having that additional level of support. And I think, let's be really frank, without government support, then most families probably wouldn't be able to cover the costs of the daily fees.
But I suppose from an investor point of view, when I'm looking at this, I take comfort that a big chunk of the income that's coming into the centre that pays the rent is going to be received from the government. So, is that government funding? Is that what investors are saying to you, Mike? Like, is that what you
Totally.
find?
This is another fundamental thing to think about childcare is it's up to 70% of the income actually comes from the government. There's not too many other investment sectors where that has the income that's pretty much government backed at 70%. Fast food, service stations, that's all sort of privately. The income comes through buying and selling, obviously buying fuel or buying food, but with childcare, it's 70% of that's subsidised. So
That's an
investors love it.
incredible level of subsidy.
It's the only sector that receives government funding.
And I think the elephant in the room is investors that are new to the sector. They think, well, what happens if the government removes their funding at the same time? But I mean, that just it doesn't. It seems counterintuitive because we've got staff. We all know that 65% of a childcare centre's cost base are staff at the same time, and in order to pay high quality, well-educated staff, we need to pay them the right amount of money at the same time. And the staffing costs are that high, and the centre operators are making a margin, but at the same time, they're providing a very high quality service as well. So without those staff, it would be unsustainable or even unachievable for a mum and dad or for parents to pay for childcare centres that weren't subsidised. So it's
and also, despite numerous governments, we've had Liberal, Labor, numerous prime ministers, the investment has continued to be increased. And regardless
bipartisan support,
but the bipartisan support for this has been huge. I think also, as you say, the government is demanding a higher quality of service, and they're willing to pay for that. But they get it back multiple. The productivity dollar investment by the government versus what they get back in tax collections, higher levels of lower levels of unemployment, higher levels of an employed workforce. They get it back. So
I think they say
it's a good
1 to
investment.
3. So for every tax dollar they subsidise, you get 3 in return through tax, future down the track, increased productivity. So it sort of does add up totally.
Yeah,
absolutely. And the incumbent Labor government, they've removed the activity test for the bottom end of the sector at the same time. So there was a requirement. You had to be in various numbers of employment per week in training or volunteer work to achieve that subsidy, but now that's been scrapped. So,
and was that across Australia or was that state based?
That's national. Yeah.
Right.
Yeah.
Wow, that's incredible.
It is, and probably the only we've got the NT government that provides additional sort of state or territory subsidies at the same time. So they've got both state and federal, or territorial and federal funding for early education.
So we've talked about obviously a depth of tenant, a range of price, a range of locations that investors can look at. I'm an investor. I now want to buy something. Can you talk to me about the assets that you're bringing to market at our August portfolio auction on the 5th, 6th and 7th of August? Mike, what are you bringing to market?
So we've in New South Wales, we've got one in Gunnedah.
Now, where is that? You're going to have to
Gunnedah's
tell
about
everyone.
an hour west of Tamworth. Right,
And
so
what
it's
feeds
regional
Gunnedah's population? What is
Sorry?
it known? What's that area known for?
farming. It's agricultural, probably a little bit of mining, but mostly farming-driven sector. The other childcare I've got is in Marylands, which again is entry level for Sydney.
So, what kind of price am I talking?
3.5 mil.
Mm-hmm. And how many? And how many licensed places is that, Mike?
62.
And is that the right amount for that type of childcare?
Oh, yeah. So as an entry-level childcare, right, we were talking earlier about, the change of quality of childcare centres. So this is like a older style converted residential house, which was what they were doing 10, 15 years ago. But as parents have been demanding better quality through better tenants and better quality services. This is an older centre, but it's definitely an entry level, great tenant, serves the community really well, and it's been around for 10, 15
But some
years.
families see benefit in
Yeah.
having a smaller centre.
Yeah, so and the other childcare centre I've got in this campaign is in Central Coast, which is a booming area. And what happened again from COVID is a lot of people moved to Central Coast because it's only 1.5 hours out of Sydney, right? So it's a really good commuting suburb. So when housing prices escalated in Sydney, we found a lot of people moved to Central Coast because it was a place that they could actually live and work, right? Have a great lifestyle. So Charmhaven's right in the middle of that growth corridor.
And how many places is that one?
That one's 127.
And what would an investor expect to pay for that kind of property?
7.5 mil.
Yeah, and what kind of yield would that be?
That would be around 6%.
Geez, that's
or
good.
lower. Just a little bit lower. Maybe.
Especially with I think the RBA, everyone thinks the interest rates will come down this year. And so together with depreciation, that's going to be a positively geared investment.
Totally. It's a modern centre. It's built in the last 5 years, so you're going to get really generous depreciation. That's another really good asset to look at for this campaign.
And Nat, what assets are we going to see in Victoria?
We've got 3 in Victoria. We've got 2 in Melbourne. So we've got 1 in Croydon.
And where is Croydon?
Croydon is a inner northern suburb of Melbourne. That particular centre completed late last year, so it's going to have really strong depreciation benefits in a really easy of access, I suppose, location on Dorset Road, with a really good medium size operator, a Victorian sort of more metro operator, Birch's Early Learning. In addition to that, we've got another centre in Doreen that Adam and I actually went and had a look at yesterday. You walk through the front door and it actually feels more like you're walking into a day spa. The guys at Eden do a fantastic job with their sort of internal fit outs.
So what other centres have you got for sale in Victoria, Nat?
Then we've got another little one, well, I shouldn't say a little one, another great one in Sebastopol, which is a suburb of Ballarat. So it's a regional location on a main road. Great thoroughfare. So it's a property that is always at the forefront of, families that are driving past. We've got those 3.
What was the third one? Oh, the Eden. Yeah, okay,
so we've got Croydon, we've got Sebastopol, and we've got Doreen. And then Adam's actually got another sister centre to Doreen, which is, the similar operator. We've got Eden.
Same operator, yes.
Yeah, same operator.
In Queensland. So that's returning 185 of income. That's a smaller centre, brand new, but that centre there is just, in terms of replacement value for land and build, the purchase price will be lower than what it would cost to replace today.
That's incredible.
Incredible. And there's some good depreciation benefits there. So that's in Barden, which is a blue chip area of Brisbane, about 6 kilometres from the CBD.
And Brisbane is booming, Adam. I cannot believe what's going on in your state. Talk to me about Brisbane.
Only since I moved there. No, I think that, and Mike and I were talking about this in the Uber on the way here, that the construction pricing in Brisbane has increased. So it's a bit of a side note here, but that's as a result of the Olympics. And I remember growing up in Sydney and, every sort of Tom, Dick and Harry was sort of on the so-called Olympic projects. And it really sort of created that vacuum of sort of trades, and it increased the cost of construction at the same time.
So how old is this centre that you're talking about?
It's 2 years old.
So you just couldn't build it again for what they built it for 2 years ago?
As a result of when it was delivered and, the cost of construction today. So, it's certainly going to be below replacement value.
And how many places is that one?
37.
Oh, wow, it's a little one.
It's a little centre.
So a really boutique centre.
Boutique centre, and the beauty with that is that there's a centre up the road. The same operator has, this is called Little Barden. They have Barden itself, which is for the smaller children and a much higher centre. So this really complements the existing and established full centre just up the road.
Right.
Tenanted by the same operator.
And the same sort of quality of fit out that Nat was talking about with the Eden Centre, is that just across all the Eden brand?
Across all the Eden brands, but across most brands and a lot of the boutique brands, they have phenomenal fit outs.
Beautiful
at the
fit outs.
same time. Absolutely. I mean, I think that's why parents sort of, there's a sort of feel good factor as well. They
Less
walk
guilt,
to these
less
centres.
mum
Yeah,
guilt.
less guilt. Yeah. And they're sort of walking, that's great. But So, so we do see that across the board. Just phenomenal fit outs as
I think
as well.
higher fit out and specs across a lot of our new childcare developments, like the one we recently sold in Hilbert in WA, like acoustic sound,
Hydronic
plaster,
heating
like-
on the flooring, and I'm glad to see gone are the days of sort of carpet on the walls at the same time. So that's certainly, we've moved on from that, which is great. But,
Corian hand basins, electric
Yeah.
soap dispensers,
Yeah.
electric tap faucets for all the children in their bathrums. Like
Smell diffusers in the nappy changing
it
areas.
certainly is long
That's
gone
an
are the
essential
days of
fit out,
walking
that one,
into
right?
some older centres that have very stale air.
Well, and talking about that's a really interesting point you make, because obviously not anyone can walk into a childcare centre. So if I'm an investor and I want to see my asset, how
Yes.
do I do that?
Good question. For us as experienced agents, we all have our blue cards. So working with children checks across across the country. It's outside of ours. If you're a landlord, they're no more complex to own than any other commercial property. The use, of course, is more sensitive. So there is the ability to inspect your centre. Generally, will be sort of out of hours, or if there's a relationship with the tenant and the lease would dictate that that you're able to walk through, probably accompanied with the centre director or their 2IC, just to sort of have a bit of a walk around at the same time. So there's
But as an investor as well, you guys can provide me with photos and video and everything I
course.
need
It's
to
of
see the
course,
property.
Yeah.
all online, and in saying that, we've got, in addition to that Barton Centre in Queensland, we've got 3 Good Start centres. We've got Aspley, Brighton, and Indooroopilly, and rents all.
And is that all Metro Brisbane?
All metro centres, and rents ranging between 150,000 and 240,000. And then we've got another affinity centre in Redbank Plains at the same time, returning circa 380,000 as well. So we've got 5 really exceptional metro childcare centres in our upcoming 7th
And at every price range there. So from
Correct.
a dollar quantum, where is that starting at and where does that go through to? Like what are we talking?
between 4 and 7 mil, so
Yeah.
give or take. Yeah.
So Nat, I want to talk to you more about lease structure. I hear gross, net, semi-gross, triple net. What is triple net?
Triple net is effectively almost like having a ground lease where the tenant is responsible for 100% of the outgoing. So if you were to use the worst case scenario and for some reason the roof fell off, it would be the tenant's responsibility to replace it at their expense. So if you're talking about the golden leases, then a triple net lease is certainly something that would give you a comfort as an ingoing purchaser. And Adam actually has 3 fantastic assets in Queensland in this particular campaign that are all leased to Good Start that are our triple net leases.
Yeah, absolutely. And as you said, Nat, there's, or as I said before, there's Indooroopilly, Brighton and Aspley. And the blanket recovery of these outgoings is so fundamentally important. I'll put my teeth back in. But management fees, land tax.
Structural,
you've got ratchet provisions and a ratchet.
So if suddenly the door won't open, they fix that.
They do. They fix absolutely everything. So
And the tap breaks.
Tap breaks, the repainting, the redecorating.
What about
any
land
type-
tax?
Land tax on a multiple hole.
it
Land
depends
tax,
on the lease.
Land tax is recoverable at the same time, and then you've got minimum rent increases as well. So
And what's the minimum rent increase?
so annually on these and in these instances, you've got a minimum of 2.5%, a maximum of 6% annually, and then you've got market reviews every 5 years.
Every 5.
Every 5. So
That's
you've got
incredible.
guaranteed rental growth because the rent can never be less than the preceding 12 months at the same time.
And I think if you're talking about a triple net lease, to me, the tenant is going to be paramount here, because obviously we want to know the tenant can afford it. So who are the tenants in this particularly these triple net leases?
These are all leased to Good Start. So Good Start are the largest not-for-profit early educational childcare provider across the country, with approximately 660 centres across all states and territories.
So a really long lease, great locations, and triple net.
And high underlying land value at the same time. So we've seen that these are established
Trifecta.
centres on large unencumbered sites with high underlying land value at the same time.
These
So,
three will be below replacement cost and again, won't
absolutely.
it?
Yeah.
Yeah, you just wouldn't be able to replace
And
them.
what kind of dollar quantum are we talking for these?
So
I want one.
Sign her up, get the contract out.
So the rents and the rents range between 140 and 250,000 per annum. Sorry, 150 and 240,000 per annum. And yields. Let's not touch on that. But
Let's see what happens.
They're going to be pretty sharp. But if we cut and go back, but average income, the incomes range between $150 and $240,000.
So they're not ridiculously high.
They're not high, so they're
rents.
affordable. They're sustainable rents at the same time,
And it's set and forget.
and we've seen some strong yield compression across these assets with previous, identical lease structures as well. So investors see the absolute intrinsic value in these assets, long-term, high underlying land value, triple net leases. I mean, they are very sought after set. Well, a lot of people, they are very sought after leases.
Okay, so I'm going to now throw to you, Nat. Out of all the childcares for next auction, which one are you buying?
Ooh.
What's your favourite?
Well, it depends what state.
No, you can have any one of them. What are you
I'm
buying?
not going to
Tell
go
me what you're
shopping
buying.
Sydney because my dollar
day
probably
spa?
can't go too far.
That's going to Barden.
Yeah. Do you know, I know Barden and I love that little centre. And it's got the most amazing wallpaper. Walking through hundreds of childcare centres, you do start to fall in love with little bits. And I know it's a bit weird to get excited about in the internal fit out of a childcare centre, but I probably would buy Barden. I really would. But if here in Victoria, if I'm putting my Victorian cap on, all three of those assets offer great value. And I think a really important point to actually focus on as well, which we did touch on, is that the most centres that we're bringing to market are always going to be below replacement cost right at the moment. You know,
Which is a massive opportunity.
it is. And like that may change if we get a few more interest rate, drops and we have some more yield compression. But right at the moment, there is a great opportunity to be buying assets below replacement cost. We see so many sites or opportunities for a potential childcare development site, but they just don't stack up. The underlying land value, and then you put the build cost on and what you can possibly cap out that rent to be in that location. It just doesn't add up on paper. And if it does, it's a very small or minimal amount of uplift of maybe $400,000. Are you really going to dig dirt for that and take on that opportunity risk? I don't think so. So at the moment, we are seeing, not just here in Victoria, but across the country at the moment, that there is a very sweet spot at the moment in the market where you are going to achieve to be able to buy a childcare centre below replacement
And how
cost.
long are all these leases that we're all talking about for this next round of auction?
New leases between 15 and 20 years
Wow.
at the same time, and they're net leases, so more often than not. And
So with a net lease, what am I getting?
you're pretty much getting everything except land tax, depending on where you are. So we can sort of explain and hold and really sort of guide investors, and they'll seek their own legal advice as well. But we can really give them a broad understanding of what is and what isn't recoverable. But generally speaking, everything except land tax in most states, in
So my
Queensland,
council rates, my
insurances,
water rates,
all of that is recoverable. So pretty much everything. And land tax is just the one that we've touched on previously. Queensland, we can recover it. Victoria, sometimes. New South Wales is exempt. And
But the best thing here is, what I'm hearing is we're sitting in a room of experts. Pick up the phone.
pick up the
You guys
phone,
have
give us
seen
a
it,
bell.
you know it, and you've sold more of this than anyone.
And I think that's a really good point, because what we do, a lot of the property that we have and we sell, if the vendors are unrealistic in their expectations, then we're busy enough that we probably won't list the property at the same time. So what we're telling you, or what we're guiding you in terms of pricing, is generally, give or take, a small percentage is what the property will sell for at auction on the day.
So that gives investors confidence. So they're turning
Confidence.
up with their finance ready, and they're not necessarily going to be let down, which, we have seen as well in other industries such as fast food, where all of a sudden it can have a run and it gets extremely sharp. But what I'm seeing here is really, really good level of return, and it's a return that we probably don't see in other industries.
So consistent.
Yeah.
If you look over a 10-year period, like draw a circle around 5%, right?
And it's been quite interesting because there hasn't been the same softening in yield across childcare because that we've seen in other sectors over the last 2 or 3 years post these rate cuts. So rate increases. Sorry, my mistake. I'm thinking about the next 4 rate cuts that are about to occur. But as a result of those, those post sort of COVID rate rises and rate increases, we've seen sort of yield stabilisation across the childcare sector, unquestionably.
And in New South Wales, we've probably only seen that sort of compress or soften 25 to 50 basis points max. So I've been consistently selling childcare centres in New South Wales in the sort of 4.5 to 5.25%, which has barely moved over the last 5-10 years.
So, Mike, out of everything we're bringing to market, what are you buying?
I am buying Charmhaven.
Why?
Because it was a point that we touched on earlier, which I sort of probably should have explained better. But with rents going up by 20-30% in the last couple of years, what I've got here at Charmhaven is it's massively under-rented. So in about 4 or 5 years from now, there's going to be a market review, and the rent's under 10% of the gross receipts, which is, we were talking earlier, 13% in Victoria.
Well, and we were talking,
15%
even higher that potentially.
in Metro Sydney. So this is under 10%. So there's going to be a real reversion. So when whoever buys this property will have the luxury in about 4 or 5 years of a massive, or potentially a massive rental increase, which was going to increase their capital value. So they're going to be buying at a really good value today, and then expect a nice reversion in about 5 years when the rent goes up.
And I think you're buying Charmhaven. Sorry to interrupt. I think you're buying Charmhaven because you don't know where Barden is. That's probably.
I think we're going to have some really active video on Barden between Nat and Adam. It's going to be a race to the finish line on Barden, obviously. Well, thank you so much for joining me today. It's been incredible to receive these insights into childcare and the whole industry as well. I would also preface that social infrastructure is across NDIS, aged care, and also medical, all of which you are experts in. So I would really encourage investors to reach out to you. I think, in summary, we've got long leases, we've got a range of prices, we've got great tenants, and we've got experts in the room who have seen these properties, walked through them, and can give first-hand advice. So thank you so much for joining me.
Thanks,
Ingrid.
Thanks, Ingrid.
Thanks, Tim.